Most people believe that if you're serious about building wealth, your money should always be invested. Stocks, index funds, real estate, always working, always growing. And on the surface, that advice sounds logical. Historically, the S&P 500 has returned around 8 to 10% annually over long periods. So if you keep your money in cash earning maybe 4% in a high-yield savings account, you're technically falling behind. That's what you've been told. But here's the uncomfortable reality. While you're being encouraged to stay fully invested, many wealthy individuals and institutions are quietly increasing their cash positions. Not publicly announcing it, not making it obvious, just slowly shifting. And that creates a question most people never stop to ask. If staying fully invested is always the smartest move, why are the people with the most money choosing flexibility instead? Let's do the math in a simple way. Imagine two people. Person A has $100,000 fully invested in the market. Person B has $70,000 invested and $30,000 in cash. Now assume the market drops by 20%. Person A's portfolio goes from $100,000 to $80,000. Person B's invested portion drops from $70,000 to $56,000, but they still have $30,000 in cash. Total net worth becomes $86,000 already. Person B is in a better position. But here's where it gets interesting. When prices are down, Person B can deploy that $30,000 into discounted assets. If those assets recover by 25% over the next cycle, that $30,000 turns into $37,500. Meanwhile, Person A is still just trying to recover losses. This is the part most people miss. Cash isn't just about safety, it's about optionality. The wealthy don't see cash as doing nothing. They see it as buying power. It gives them the ability to act when others can't. And that matters more than squeezing out an extra 3 or 4% during stable times, because real wealth is often built during unstable periods. Think about 2008. Real estate prices dropped by roughly 20 to 40% in many areas. Investors with liquidity were able to buy properties at massive discounts. A house worth $400,000 pre-crash might have sold for $250,000. That's not just a deal. That's a complete shift in long-term returns. If that property later recovered to $400,000, that's a 60% gain, not counting rental income. But only people with available cash could move quickly enough to take advantage. Now bring this into your world. If you're earning between $60,000 and $120,000, paying rent or a mortgage, dealing with car payments, groceries, insurance, maybe childcare, your financial margin is already tight. Most people in this range don't have large cash reserves. In fact, studies show that nearly 60% of Americans can't cover a $1,000 emergency without going into debt. So when the market drops, instead of seeing opportunity, it feels like pressure. You're not thinking about buying assets. You're thinking about job security, bills, and survival. That's what it means to feel financially trapped, not because you're making bad decisions, but because your margin is too thin to take advantage of opportunities. This is where the system feels broken. The advice given to you is often based on long-term averages, but your life operates on short-term realities. You don't experience the market as a 30-year average return. You experience it through monthly cash flow. If your investments drop 20% at the same time your expenses increase, your stress level goes up immediately. And that stress forces decisions. Maybe you stop investing, maybe you sell at a loss, maybe you delay important life plans. Meanwhile, someone with strong cash reserves is operating from a completely different position. They're not reacting, they're preparing. Let's break down how the wealthy actually build these cash positions. It's not random, it's strategic. During periods of strong market growth, instead of staying 100% invested, they gradually take profits. For example, if a portfolio grows from $1 million to $1.3 million, they might pull out $100,000 or $150,000 and move it into cash or short-term instruments. Not because they think the market will crash tomorrow, but because they understand cycles. Markets don't go up forever. Corrections happen. And when they do, having liquidity matters more than being fully optimized for growth. Another important detail is income structure. Wealthy individuals often have multiple income streams, dividends, rental income, business profits. This allows them to build cash without completely exiting investments. If someone is earning $200,000 a year and living on $120,000, that extra $80,000 can be partially allocated to cash reserves. Over 5 years, that's $400,000 in liquidity. Compare that to someone earning $80,000 and spending $70,000. Their ability to build cash is limited, even if they're disciplined. This isn't about intelligence or effort, it's about structure. And this is why comparing your strategy directly to the rich without adjusting for your situation can lead to frustration. You're playing a different game with different constraints. You're balancing stability, growth, and day-to-day life all at once. They're optimizing for opportunity and scale. That doesn't mean you're failing, it means your approach needs to be more intentional. Here's a practical way to think about it. Instead of asking, should I invest or hold cash? Ask, how much flexibility do I need? For someone with a stable job and low expenses, maybe holding 3 to 6 months of expenses in cash is enough. For someone with variable income or higher financial pressure, maybe 6 to 12 months creates a more stress-free environment. Let's use actual numbers. If here's monthly expenses are $4,000, a 6-month reserve is $24,000. A 12-month reserve is $48,000. That might sound high, but think about what it buys you. Time, stability, and the ability to make better decisions under pressure. Because at the end of the day, investing isn't just about returns, it's about behavior. And behavior is influenced by how secure you feel. If every market dip makes you anxious, you're more likely to make reactive decisions. But if you have cash sitting on the side, you're calmer, more patient, more rational. That's the hidden advantage most people underestimate. It's not just financial, it's psychological. So when you hear that the wealthy are holding more cash, it's not because they've lost faith in investing. It's because they understand timing, cycles, and flexibility at a deeper level. They're not abandoning the market. They're preparing for the moments when the market gives them better opportunities. And that mindset shift, seeing cash as a strategic asset rather than wasted potential, is where everything starts to change. Now, here's where the story really comes together, because once you understand why the wealthy build cash, the next question becomes even more important. Why are you still being told to stay fully invested no matter what? Why does every piece of advice sound the same? Don't time the market, just keep buying. Stay the courses on the surface. That advice isn't wrong. In fact, for many people, especially those who panic sell during downturns, staying invested is better than jumping in and out. But here's the part that rarely gets explained. That advice is designed for the average investor's behavior, not for maximizing opportunity. Let's break this down with actual numbers. Over the last 30 years, missing just the 10 best days in the stock market can cut your total return by more than half. That statistic gets repeated everywhere. And it's true. But what doesn't get talked about is when those best days happen. Historically, many of them occur during highly volatile periods right after major drops. For example, during the 2008 financial crisis, some of the biggest up days happened within weeks of the worst declines. So the message becomes simple. Stay invested so you don't miss those rebounds. But here's the uncomfortable reality. That same volatility is exactly what creates opportunity for people holding cash. Think about it like this. If the market drops 25% and then rebounds 15%, someone who stayed fully invested is still down overall. But someone with cash can step in during that 25% drop and capture the upside from a lower entry point. Let's do the math. A stock priced at $100 drops to $75. Then it rebounds 15% to about $86. If you bought at $75, you're already up around 14%. If you held from $100, you're still down 14%. Same market, completely different outcome. That's the power of liquidity combined with timing. Not perfect timing, but prepared timing. Now let's talk about incentives, because this is where the messaging gap becomes clear. Large financial institutions, retirement systems, and even fund managers benefit from consistent participation. The more money that stays invested, the more stable the system becomes. If everyone started pulling out cash at the same time, markets would become far more volatile. So the default advice becomes simple and broad. Stay invested. Keep contributing. Don't overthink it. And again, for someone who doesn't have the time, knowledge, or emotional control to manage timing, that's not bad advice. but it's incomplete. Because the wealthy are not following a one-size-fits-all strategy. They're operating with layers. They have long-term investments that stay in the market. But alongside that, they maintain liquidity for tactical moves. It's not either fair, it's both. And this is where most people feel confused. They think they have to choose between being fully invested or sitting on cash. But the real strategy is allocation. Let's bring this into a real-life example that fits your situation. Imagine you're earning $90,000 a year. After taxes, maybe you take home around $65,000. Your annual expenses are $50,000. That leaves you with $15,000 of potential savings. Now, if you put all $15,000 into the market every year over 10 years, assuming an 8% return, you might grow that into roughly $220,000. That's solid progress. But during that same period, if a major downturn happens and you have zero cash, you're forced to just ride it out. No ability to take advantage of lower prices. Now compare that to a slightly different approach. You invest $10,000 per year and keep $5,000 in cash or short-term reserves. Over 10 years, you'd have $100,000 invested plus whatever growth comes from compounding, and $50,000 in liquidity. Yes, your total invested amount is lower, so in a perfectly smooth market, you might earn slightly less. But markets are not smooth. They move in cycles, and that $50,000 becomes your opportunity fund. When assets drop 20 to 30%, deploying even part of that cash can significantly increase your long-term returns. This is the part where people start to realize the trade-off isn't as simple as cash versus investing. It's about positioning. Cash gives you control. It increases your margin in your budget, not just in monthly expenses, but in strategic decisions. It allows you to act instead of react. And that's a completely different mindset. Now let's go one level deeper into what actually happens during downturns. When markets fall sharply, most people don't suddenly become aggressive buyers. They become cautious. Even if they know prices are lower, fear takes over, headlines are negative. Job security feels uncertain, so instead of investing more, many people pause or even withdraw. This is not a character flaw, it's a natural response to uncertainty, but it creates a gap between what people should do and what they actually do. And that gap is where the wealthy step in. Because if you've already built your cash position before the downturn, you're not making decisions under pressure. You're executing a plan. Maybe you decide in advance that if the market drops 15%, you deploy 25% of your cash. At a 25% drop, you deploy another 25%. You don't need to guess the bottom. You just need to follow your structure. That's how disciplined investors operate. Not perfectly, but consistently. And this doesn't only apply to stocks. It applies to real estate, business opportunities, even career moves. During economic slowdowns, assets often become more affordable. Sellers become more flexible. Negotiation, power shifts. If you have cash, you can take advantage of that. If you don't, you're stuck watching from the sidelines. And that's where the feeling of being financially trapped becomes very real. So what does this mean for you, practically? It means you don't need to copy the wealthy exactly, but you do need to understand the principle behind their behavior. Build a base level of security first. That might mean a 6 to 12-month emergency fund. Then, instead of pushing every extra dollar into long-term investments, consider creating a separate opportunity fund. Even if it's small at first, $2,000, $5,000, $10,000. It changes how you experience market movements. Drops stop feeling like threats and start looking like potential entry points. Because real wealth isn't just about maximizing returns in good times, it's about being positioned to act in difficult times. That's where the biggest gains often come from. Not from constant exposure, but from strategic deployment. And that's the part most advice leaves out. So when you hear that you should always stay invested, understand the context. That advice protects you from emotional mistakes, but it doesn't fully prepare you for opportunity. And when you see that the wealthy are holding cash, don't interpret it as fear. Interpret it as readiness. They're not stepping away from the game. They're making sure that when the next opportunity shows up, and it always does, they're in a position to move. At the end of the day, you're not trying to outsmart the market. You're trying to build a system that works for your life. One that gives you stability, reduces stress, and creates real options. Because freedom in finance doesn't come from being fully invested all the time. It comes from having the ability to choose when and how you invest. And once you start thinking in terms of flexibility instead of just returns, you stop feeling like you're chasing wealth and start feeling like you're actually building it.